Hi, this is Ankur. In this video, we'll talk about ways how you can invest your money safely. So let's get started. So the first option we have is fixed deposit. This is a very known option. The only thing you have to be careful is go with banks that are extremely safe. Do not be incentivized by a little bit extra return and the safety of capital is not there. We have seen in the past with Yes Bank and a lot of other cooperative banks that your money, even in banks, can come into trouble if the bank is going in a troubled state. So I would suggest that you can start with public sector banks. Say SBI is a safe option. In private sector space, ICICI, HDFC is a safe option. To a very great extent, even Axis is a safe option. But do not be incentivized by extra 1% return or 1.5% return, and you invest in banks that are not well capitalized. The rate of return you can expect in fixed deposit is something that matches inflation in the economy over a period of time. So in current times, you will be getting around 5.5%, 5.75% kind of return over 370, 380 days. But please note, this is a pre-tax return. Obviously, after applying for taxes, when taxes are paid off, the return is very marginal. However, it is still something that provides safety of assets. So this is the first option anyone can evaluate and should have some allocation within fixed deposit. As a safe option, you can keep 3 months of your living expense as part of rotating fixed deposit that renews after every 3 months. So that is the amount you can keep in fixed deposit. So let's say if your living expense is 2 lakh rupees per month, I'm saying that you need to have in total 6 lakh rupees of fixed deposit. So the next option is a liquid fund. A liquid fund is a fund that invests in treasuries. Go with conservative asset management companies such as Parag Parikh or HDFC. We have seen Franklin fiasco in 2020. You don't want to be caught up in that situation. So always go with a conservative asset management companies within debt. You do not want to make investments in questionable asset management companies. The return expectation should be around 3.5-4% within liquid funds. As the rate continues to increase, you can expect a higher rate. But obviously this will not beat inflation on a after-tax basis. However, it is an extremely safe form of investment. One advantage over a fixed deposit when you invest in a liquid fund is you can withdraw money at any point in time, and the next working day only, you get the money in your bank account. So that is one very great advantage in liquid fund, which might not be there in fixed deposit, where you have to pretty much break the fixed deposit in order to get the money. We move on to the third option, which is short-term debt fund. Short-term debt funds would be riskier in comparison with fixed deposits and liquid funds because the investment horizon, the instruments they are investing, they mature within 1 to 3 years. That is the duration of the funds. In a simple way, what we are saying that if there are changes by central bank, the interest rate is changed, there may be some impact on these funds. A short-term impact could be there. The return expectation should be around 6% in short-term debt fund. And again, the logic of going with an asset management company that is extremely conservative is also applicable for this category. The fourth option we have is a conservative fund. There are many conservative funds in the market. What I am referring is conservative, not just by name, but in true sense. So I've come across Parag Parikh Conservative Fund, which was launched a year back now. And the strategy of this fund is reasonably sound. Obviously, this is more riskier than a fixed deposit or a liquid fund or even a short-term debt fund. So the horizon you should have when you're investing in a conservative debt fund should be more than 1 year. There are many forms of conservative funds, so you need to be careful. A conservative fund should be one that provides a little bit safety of capital over a 1 year plus kind of horizon, and they would be investing in high dividend yield Equities, often government-owned stocks, basically where the dividend yield is very high. A combination of commercial papers by very solid companies, and also state government issued bonds. These are not backed by Government of India, but these are pretty safe. At least in Indian context, we can say that the default probability is extremely low. The return expectation you should have from conservative fund would be around 7.5% over a 1 year plus horizon. And the last option is conservative strategy run by Plutus Capital. So I am the fund manager for this strategy. And let's look at this strategy for a minute in terms of what we do and what should be the expectation around this strategy. So this strategy basically invests in stocks that are high dividend yield stocks. It would include PSU bonds. We get exposure through Bharat bonds, and we also invest in real estate investment trust where the yields are between 7 to 8%. What you can expect from the strategy is around 7.5% again. There is no lock-in, there is nothing, but we expect people to invest in this strategy with a horizon of 1 year. It should not be taken as a just a saving account where you are investing money and you're withdrawing money. It should be done with a horizon of 1 year. The expectation should be around 7.5-8%. So out of all these 5 strategies, the most conservative is the fixed deposit. Liquid funds would also be categorized in a similar bucket, followed by short-term debt fund, and conservative fund and conservative strategy by Plutus Capital would be categorized in one bucket. You can always go on this link that can help you understand conservative strategy better. Here are the expected returns across all these 5 categories. I hope you liked the video. Thank you for watching.